All right, let's talk about Procter Gamble. Go ahead, open your medicine cabinet, look under the kitchen sink, check out the laundry room. I'm willing to bet you'll find a P&G product. This company is an absolute giant in the consumer world, one of those quiet titans whose brands are just everywhere in our daily lives. And that brings us to the big question, right? We know their products have a permanent spot in our homes, but does that mean the stock deserves a spot in your investment portfolio? It's a great question. Let's really dig into it. So let's start with the bull case. The best way to think about P&G is like an economic fortress. It's built on a foundation of things we all need every single day. This is the argument for its incredible, almost boring stability and strength. Now, P&G's power isn't just one big thing. It's spread across 5 different business segments. And as you can see, the biggest piece of the pie is fabric and home care. That's more than a third of their sales. This is really the engine room. We're talking powerhouse brands like Tide and Dawn that just generate massive, predictable cash. Why? Because, doing the laundry and washing the dishes, those are non-negotiable. And where is that engine located? Well, take a look. It's right here in North America, making up over half of all their sales. Now, this tells you something really important. P&G isn't some high-risk, high-growth bet on emerging markets. Its financial heart beats in the huge, mature, and super stable consumer base right here in the US and Canada. So, how does P&G protect this fortress? Well, investors have a term for it, an economic moat. And it's exactly what it sounds like, a barrier that makes it incredibly hard for competitors to even try to attack. P&G's moat is wide and deep. It's been dug over decades with billions spent on advertising for brands we all know, a manufacturing scale that just crushes smaller rivals on cost, and rock-solid relationships with retailers like Walmart. And the result of that powerful moat? Pure market dominance. I mean, in the categories that really count, P&G isn't just a player, it's often half the entire game. Think about diapers. It's basically Pampers and one other competitor. Toothpaste. Crest is right there battling Colgate. And in the laundry aisle, Tide is the undisputed king. That kind of market setup is a recipe for serious profitability. And all that profit, all that stability, what does it lead to? It leads to this number, 69. That's 69 consecutive years of dividend increases. That's not just consistent, that's legendary. This puts P&G in a super elite group of companies called Dividend Kings, making it a cornerstone for anyone investing for income. And this right here is the foundation of the bull case. It's a remarkable, almost unbelievable record of just being consistent. For over a century, through wars, recessions, you name it, P&G has reliably sent cash back to its shareholders. For a lot of investors, that track record is pretty much the definition of a safe investment. But no fortress is perfect. Now we've got to flip the coin and look at the bear case. The very real, modern threats that are starting to show some cracks in P&G's century-old walls. You see, the world has changed, and the old playbook that made P&G a giant is being seriously challenged. Their moat was built on 2 main things: huge TV ad budgets and totally dominating the limited shelf space in physical stores. But what's the new reality? It's social media and the infinite shelf online, where smaller, nimbler brands can suddenly compete on a much more level playing field. And the threats aren't just from those hip new startups. High-quality store brands, think Costco's Kirkland Signature, are serious competitors now. With inflation squeezing everyone's wallet, more and more people are realizing they can get fantastic quality without the brand name price tag. This is not a niche thing anymore. Private labels now grab almost a fifth of all consumer goods sales in the US. And all this competitive pressure? It's starting to show up in the actual numbers. After a few years of solid growth that was really driven by price hikes, P&G sales growth slowed way down to just 2%. The actual volume, the amount of stuff they sold, was flat. It really makes you wonder if they're hitting a ceiling on what people are willing to pay for those brands. And this gets right to the heart of the bear case. It's what you might call the saturation problem. P&G's biggest, most profitable market, North America, is mature. There just isn't much room for growth in how much stuff people buy. This forces the company into a brutal, expensive slugfest for tiny slivers of market share against really tough competitors. So, facing all these challenges, how is P&G defending its fortress? Well, management isn't just sitting around. They've got a very clear, integrated strategy to fight back and try to carve out new ways to grow. Okay, so here's the official battle plan. It's a 5-pillar strategy, and each step kind of enables the next. It all starts with a focused portfolio of products we use every day.
The goal is to make them noticeably superior through innovation, which gets paid for by being relentless on productivity and cutting costs. This lets them disrupt their own categories before somebody else does, all held together by a quick and accountable organization.
Now, that whole product superiority thing, it doesn't just happen by magic. It's fueled by this number. Over $2 billion. That's what P&G pours into research and development every single year. It's that massive budget that lets them create things like new Tide Pods or better Swiffer mops that can actually justify a higher price. And P&G knows it can't just keep raising prices forever to grow. So it's making a pretty major strategic pivot. It's looking inward for growth. They're making a big move to restructure their non-manufacturing jobs, all with the goal of boosting productivity. That frees up cash to pour back into R&D and marketing, basically finding growth through efficiency, not just by taking more from the consumer's wallet.
So we've got the super stable bull case on one side and the disruptive bear case on the other. For an investor, this creates a real dilemma that, honestly, boils down to one thing. What's the right price to pay for this kind of quality?
Here's something that is absolutely crucial to understand. The market already knows P&G is a high-quality, safe company. And that safety and quality come at a cost, a premium price. Investors aren't buying this stock for explosive growth. They are paying up for stability and predictability. That's already baked into the stock price. Let's look at the hard data for a second. When you compare P&G to its peers, companies like Unilever and Colgate-Palmolive, it consistently trades at a premium. Its forward price-to-earnings ratio is nearly 22. Its price-to-sales is over 4. Those are just higher. And that's not an accident. That's the market saying it's willing to pay more for what it sees as lower risk. That's the tangible cost of that safety premium. And that leaves you, the investor, with a very clear choice. On one side, you've got the bull case, best-in-class profits, a legendary dividend, and a safe harbor in stormy market seas. On the other side, you have the bear case, pretty slow growth, the very real threat of disruption, and a high price tag that already seems to account for all the good news. So ultimately, investing in P&G comes down to this one question. Are you paying for the promise of future growth, or are you paying for the proven quality and safety of today? The right answer really just depends on what kind of investor you are and what you're trying to accomplish with your portfolio.